Good morning, traders. It is 8 a.m. Chicago time, November 24th, 2014. Thanks for joining me, and thanks for welcoming me back for those who did. It's been an interesting couple of weeks, and I'm glad to be back in the seat and looking at the markets again live rather than in hindsight as part of this prop training that I was doing in India. A lot to cover here. Just like I do with the market, I like to go back and look at the history of what has happened, news and so forth. So I'm going to recap the last 2 weeks real quick, and then we'll move into what's expected for today as far as economic releases, and then we'll look at what's happened over the last couple of weeks in charts technically, and then all of that in an effort to distill down to what we should expect today and for the rest of the week. So the recap over the last 2 weeks, I know you've been trading, so you might feel that this is not interesting, but it's important to see how things have played out. With QE in the U.S. having come to an end, it appears that other economies have stepped in to provide liquidity in one form or another. It's very interesting that that's happened. Treasury markets have been are being bought by some unknown very, very large buyer out of Belgium. It's suspected this is a sovereign fund of some sort. The U.S. stock market has had 5 straight weeks of gains. I want to go over some numbers on the S&P as a representation of the market overall, and how this 5-week straight gains stat is working out. For the year, looking at the numbers for the year, the average close up on the year was 8.82 points on the ES. Day session only, I'm looking close to close. For the day session, the average down close was 11 points. So we've gained 8.82 points when we closed up, and we've lost 11 points when we closed down. There have been 139 up days. 139 up days. So if you take 139 up days, multiply it by 8.82 points per up day, you get 1,226 points gained on up days. And then there have been 90 down days at 11 points per down day. That's a negative 990 points lost on down days. The difference between them is how much we're up for the year. On December 31st, 2013, the S&P 500 futures closed at 1824. Friday represented the highest close in that product's history, and that makes it positive 237.75 points for the year since December's close. So that's a pretty good return of about 13%. The up volume, when we close up, the volume is 1.14 million contracts on a day session, 1.14 million contracts, and then the down volume, 1.48 million contracts, 1.48 million contracts on the down volume. Obviously, down volumes usually higher than up volume. From close of last year to the peak of this year, which also happened on Friday, the peak being 2072 and a quarter, 13.6%. Peak to trough, the entire range of this year is 2072.25 down to 1709.75, 1709.75. A total range for the year of 362 points, 362.5 points. Which is about $18,000 per contract for that range, $18,000 per contract. And then the other thing I looked at while I was studying how this year was materializing, since we're approaching the end, I looked at all the corrections. We've had several corrections this year, none as big as the one we saw in October. But we started this year with a correction from 1823.50 to 1709.75, which again represents the low of the year, which was 6.2%. 1877 to 1792 85-point correction, which represents 4.5%. So we went 6.2%, 4.5%, and then the next correction was 1977 to 1891.75, which represents 4.3%, in line with the prior correction. And then the biggest correction was the 2012.75 high to the 1813 low, which was made at the end of September through the mid of October, which was a correction of about 200 points or 9.9%. And since then, we went from 1813 even to 2072, whatever it is, 25. So pretty strong run into the close of the year, which is a seasonality. So I just wanted to go over a recap of that. Going back to from when I left, nothing really significant. I left on November 7th, Friday. Nothing really significant until Wednesday, November 12th. China new yuan loans, 626.4 billion. The Friday, November 14th, we have German GDP. We had German GDP at 1.2 versus 1.1. Eurozone GDP at 0.8 versus 0.7. So good news out of Germany and the Eurozone GDP-wise. U.S. advanced retail came in at 0.3 versus 0.2. Also good news. And in University of Michigan, came in at 89.4 versus 87.5. All wonderful news that Friday. The market liked what it saw that day, but didn't really go anywhere. That Friday was an inside day of the prior day. Pretty dull trade despite all that news. On Sunday, November 16th, Sunday being U.S. or Chicago time, Japan's GDP came in at negative 1.6% versus expected 2.2%, officially putting Japan in a recession and missing analyst estimates by just a grotesque amount. 3.8%. They're off by 3.8% on Japan's GDP. That's just enormous. Caused a bit of a shakeup overnight, but overall the market didn't really do anything to respond to that. It actually traded almost inside of Friday's range again, recovered completely by the time the market had closed. On Tuesday, Great Britain had its CPI come in at 1.3 versus 1.2%, so that's good news. The German ZEW, which is the economic sentiment survey out of Germany, came in at 11.5 versus 0.5, total blowout number on Tuesday the 18th, and we saw a pretty decent rally to new highs that day. The high of the day there was 2054 even. If you recall, the last trader bite that I did before I left, I had indicated that 2055 had a double measured move target, and that would be a key area to test. And that day fell short by 4 ticks. Wednesday, November 19th, FOMC meeting minutes came in and revealed little to the market other than that the inflation target of 2% has not been attained by the Fed. It's just, with it not attaining the 2%, it just goes to show that there's a lot of pressure on not increasing rates, since the stimulus that we've had and are still having in some ways is not bringing inflation above the point where the Fed mandate requires. And it also indicated, the minutes also indicated that the European and Chinese economic issues may have a spillover effect on the U.S. economy and growth. Again, meaning that the Fed cannot raise rates, is not likely to raise rates as it had intended. Thursday, November 20th, we had U.S. CPI, came in at 1.7% versus 1.6%, a little bit better. And then last Friday, China's central bank cut one-year benchmark rates by 25 basis points to 2.75%. and it cut its one-year lending rate by 40 basis points to 5.6%. It also raised the ceiling on deposit rates from 1.1 to 1.2% of benchmark rate. This gives banks a little bit more leeway to attract business and set rates of what they're going to pay out to their customers. So on Friday, we saw overnight at about 4 a.m. Chicago time or so, we saw a strong pop of about 11 points up on China, making a move to ease on its interest rates. Very interesting, isn't it, that the U.S. ends its QE taper, and it seems like Japan and China and New Zealand and so on all kick in with theirs. I want to remind everyone that there is a seasonality in play here for Thanksgiving. Generally, November is a plus 1.5 to 2% on a seasonality, with another 1.5 to 2% for December on the plus side. So Thanksgiving time here, Thanksgiving is this Thursday in the US, is bullish through the end of the year. This does not mean we buy and hold. It's just an indication of a seasonality that may be in play as you decide on what to do with short positions as you take them, if you take them. Just remember, there's pressure, bullish pressure into this week, into Thanksgiving. German November IFO business climate came out this morning, 104.7 versus 103. Germany just for the last 2 weeks coming in with some really strong numbers after some pretty nasty ones in October. And then finally, nuclear negotiations in Iran. The time for those has expired, but they've been extended to June 30th of 2015. It is said that they're aiming for a political agreement in 3 months. Looking ahead at what's on deck for today, looks like at 8:45 we'll have U.S. PMI services preliminary. I don't have a consensus number. At 9:30 Central Time, Dallas Fed manufacturing activity expecting 8.0, and then other than that, I'm not really seeing much. ECB Speaker Weidemann had was spoken the last hour, and then at 8:30 ECB announces its covered bond purchases, and then this evening at about 5:50 p.m. Central, the Bank of Japan releases its October 31st meeting minutes. As far as auctions, we have the standard 3-month and 6-month bill auction at 10:30 Central, expecting 24 and 28 billion. And then at noon, we have a new 2-year note auction for 28 billion as well. That concludes the summary of what's expected for today. I want to remind you again that it is a holiday week later this week. On Thursday, we have Thanksgiving. So generally on Wednesday, the trade comes to a pretty sluggish stall early in the day as people hit the road. Wednesday is the most traveled day of the year. It's the busiest traveling day of the year, above any and all other vacations or holidays. So most people head out early. So Wednesday afternoon is expected to be fairly quiet. The market in the past has drifted up through it. The market reopens on Friday. However, it'll be a limited action. But again, on Friday, I've seen it for the last 2 years just drift up on little to no volume. So be cautious if you're going to trade these days. Do not take for granted the fact that these markets can and will move on very little volume, and they have in the past, even though it's a holiday. So even though the interns are in charge, they're able to buy up the market just like everyone else. So so that's what we're looking at. Let's take a look at the markets overall, the technical picture, which is probably what you're here for. So you should be seeing my charts here. I'm going to start out with a very, very big picture view on how the market has traded. This here is a market profile chart on a monthly basis. This is looking at half-hour brackets on a monthly basis, and it's building a profile based on the activity for the month. If you look at October's range, you can see that it's quite massive, with the final day of October giving us a pretty strong gap, and it closed above the high volume node of that day before November opened right at this notch right here, this little blur. And then what November's done is it opened and then it tested down into that gap zone. It didn't quite close it. We have about 5 ticks remaining on that gap. I still have an open gap marked for this time period, but overall November is another elongated profile. It is the 24th. We have one more week of trading. However, that week only represents about 3-4 days of trading, since November has 30 days and the 30th of November is next Sunday. So we have today, tomorrow, Wednesday, and Friday to finish the month. And you can see here that November is another elongated month with some value really strongly built in the 2029, 2030 area through the 2040 area. That area represents the strongest portion of the value area of this month. We have a small gap above that we left behind on Friday, and overall the market is not balanced. That's what we want to look at. So if you look at, for example, July built a pretty decent value area, even though it had a tail on it and it finished near its lows. It did build some pretty decent value, traded most of the month in a pretty decent value range. But you look at November, and it's just the market's really desperately seeking value, and has spent most of its time in price discovery mode, and it looks to finish the month in price discovery. This is a lethal market for the perma bears, as they have struggled to make anything of shorts. Shorts are short-lived, as I've been talking about for months and months now, that nothing really indicates that the long-term players are stepping out of their buy positions. So I like to look at this chart just to see where things played out on a monthly basis. Looking at what we've had for a while here, this is my measured move chart. This is also the chart I use to track the delta with. Unfortunately, since I restarted my charts this morning, it reloaded a lot of the volume, and I lost the tick volume that I've had for months on this chart. I'd have to reload it after the market closes. But this is a chart I pull my measured moves from, and you can see here the measured move target at 2055. I have a measured move that I inadvertently erased this morning as I was doing some homework, which was at 2056, and that gives us a confluence that we had at 2055. The next key area above is 2077.50 for the measured move. But you can see here from the 1813 low that this thing has been just steamrolling up, very methodical, higher lows, one time framing up through most of it, with some limited down days. So this is a quick analysis here on a daily basis, and through this, all I'm doing is checking to see, I'm measuring the current close versus the prior, and where it says true, it means this current day closed higher than the prior day. And the more important factor is, when it closed down, how far down did it close? So if you look at these falses versus these true meaning it closed higher than the prior day. If you look at the falses, they're just tiny numbers compared to the up days. So the up days are still on the close are still fairly strong, except of course in October where we had some pretty decent down days, as you saw on the chart. But since then, the up days have been a lot stronger than the down days. You can see here 16.5, 21 and a quarter versus 7.75 down, 5.5 down versus 13 up, 9 up, 2 down, 8, 2.5, and then only less than a point down, and then 2.25 points down, and then 0.75 points down versus all these up days. So the market's clearly seeking prices. It's in price discovery mode higher, and with with Friday opening high but finishing lower. But overall, Friday is a higher high, higher low. The point being, the long-term, intermediate-term trends are up, and so is the short-term trend, even though Friday opened with a gap and closed lower. Friday essentially took back the China announcement. You can see here on the overnight session, it opened right at the prior day's high, Thursday's high, and it started its price discovery lower and then was met with some buyers, and it was sideways before it started to drift out of Thursday's range. This is Thursday, this is Friday's reopen at 5 p.m. And then the market just drifts up and drifts up all night through the China session, through the Asian session, and then it gets even stronger into the European session right here before the People's Bank of China kicks in with a strong, with that rate cut announcement to push the market all the way up with a weak high on the close of the overnight session. And then of course, a weak high on the overnight session, we end up taking that weak high out as expected, with a push to 2072 and a quarter, and then the market basically takes back the entire rally overnight, and then just rests in the middle. Overall, this day shows little agreement on price. It seems to be a price discovery day. The profile, although it's the value area is valid here, it's barely valid. We do not have a normal distribution or anything that looks like a normal distribution, but the market did find its buyer 2054.75 and came all the way back through to trade towards the mid of the session. You can see here the mid of the session is 2063.50, and it came right back to it. And then since then, all it's done is trade sideways on the Asian session, and then it started to trend higher with the European markets. And of course, with the German release, we got a little pop here to new highs. It came out at 3 a.m., represented by this 315 bar, and has continued to drift up. So still very bullish. Be careful if you're looking short. With the market trading at 2067, the high at 2068 and a quarter, at new highs, I don't have any other conclusion than to suggest that it looks like it's probably the expectation this morning is that we would have a brief test lower. You could see the overnight low is at 2060.75. No coincidence here. That was the most traded price of the day on Friday. That was the point of control. The expectation is for today to be a sideways trade on the open. We do have a number at 8:45 Central, just 15 minutes into the open. And then I expect the market to, after it tests lower, I expect the market to drift back up and start walking its way back to 2072.25, barring any change to the overall picture. I cannot come to any other conclusion than for the previous trend to continue and for the normal business that's been taking place on the long term from the long-term players to keep buying. I expect that to continue. I don't see any reason why I should take a bearish tone here. other than the fact that it did make new highs. And if you recall, for the last couple months, I've been saying that when the ES has made new highs, it was confronted with selling almost immediately. But we already had that on Friday. We did not close the gap. So we have a gap magnet below. We have a flat, you can see here, an LVN zone between 57 and 53 that might attract, but I'm not interested in looking at that, targeting that on a short trade until and unless the market gives up 2060 75 and starts drifting lower. 2060 50, 2060 75 is expected to be pretty decent support. So don't be surprised if it does get to the overnight low, that it pokes through it by a couple ticks before it finds buyers to come back in. Today, it would not be surprising to me to see today as an inside day, given that a lot of people have taken off already for the week to take advantage to take off for a whole week by giving up 3 vacation days on their work schedule. So expect volumes to be lighter, expect the market to kind of aimlessly drift a little bit. However, that is my primary hypothesis, right? Primary hypothesis is that it opens kind of noisy. PMI comes out. We're likely to take out the 2068.25, but I'm not looking for a breakout trade to new highs. I'm looking for some responsive selling to come in and bring us back down to Friday's close of 2060. 150, 2060, 175 before it finds its groove and starts to move up again. That's the primary hypothesis. However, as I've said many times, that if I'm happy to be wrong. I'm happy to be wrong. I'm happy for the market to prove me wrong. And if the market decides to sell off strong on the open, that is a much better indication that I'd feel much more confident taking a bias on the market than if it fulfills the primary hypothesis, because if it comes in strong, either buying or selling, it tells me that that there's a lot more confidence on the move. I don't know if you've ever heard of the Monty problem. It's a mathematical problem that was created based on a game show. I won't get into it. You might want to look into it. But basically, the way these hypotheses work, it's the same. The issue with the Monty problem, well, maybe I'll get into it. Well, actually, we're running out of time since the market opens here in a little bit. But look it up and discover why the Monty problem is an interesting math problem. The way hypotheses work, it's the same way. If the primary hypothesis is canceled, then there's a much higher probability of the other hypotheses working out. So I have a lot more confidence in those trades once they kick in. I'll leave you with that thought. I'm very glad to be back. Love being in my trading routine and love being present here. Thanks for joining me today. Good luck. Please watch your risk. It's likely to be a slow week, a very drifty week. So don't risk too much on any one trade. Good luck, and I'll catch you soon. Take care.